You can go with the flow when it comes to investing, continue to deal with the income outage of bonds, or discover the power of dividends with higher-yielding sectors of the S&P 500. Like utilities, XLU can transmit the benefits of equity income to your portfolio. With liquidity, all-day tradability, and transparency. Ready to plug into a different source for income? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
I'm DeLegge with ETFguide. Welcome to Marketplace Minute. Why do individual investors underperform? Here to talk with us about that is Terrance Odean. He's a professor of finance at the Haas School of Business at the University of California in Berkeley. Welcome to the show. Great to have you with us, Terrance Odean.
Thank you.
The bulk of research in modern economics has been built on this notion of the rational investor that tries to maximize their investment wealth and minimize losses. But your research actually shows quite the opposite. Just tell us a little bit more.
All right. Well, as you said, modern financial theory, at least until probably 15, 20 years ago, was dominated by the idea that people are very rational when it comes to money. And as I think all of us realize, that's not always the case. So I've done research, and I've worked a lot with my colleague Brad Barber, where we look at the actual trading records for individual investors. We've looked at trading records for hundreds of thousands, at this point even millions of investors, and we found a lot of pretty predictable patterns. There's not all investors, but especially self-directed investors trade excessively, and one very strong finding that we have is that the more actively investors trade, on average, the less they earn. In fact, in an interesting twist, we looked at the difference in how men and women invested, and our hypothesis was that men would be more overconfident than women, and as a result trade more, and this trading would hurt their returns. We found that men traded much more actively than women, and like 1.5 times as actively as women, and that this active trading really cut into their returns.
Now let's talk about some research that you did focusing on day traders in Taiwan. This was a 14-year study that you conducted. What did you find, and were you kind of surprised by those discoveries?
What we found was not actually that surprising. Most day traders lose money. And we looked at Taiwan because we got this phenomenal data set. We know every trade made by every investor in Taiwan over this 14-year period. And Taiwan has a lot of day traders, and 90% of them are tending to lose money. I mean, in any given 6-month period, maybe 20% of them will come out ahead, but most of those are just lucky. And persistently, there are a few that actually make money predictably, but most of them are not doing so.
Do you think that data sample in Taiwan, that 14-year study, do you think that crosses cultures, crosses over to borders? For example, does that apply to U.S. investors?
So here the big issues are this. In Taiwan, there's a transactions tax that makes it hard to be a day trader.
Okay.
And so that's relevant. But in the U.S., investors face more of what economists call asymmetric information risk. And really what that means is if you're an individual investor and you place an order to buy or sell a stock in the US, it's very, very likely the person on the other side of that trade is an institutional investor, an investor who has more resources than you, more experience, more data, is working with a team, and on average, you're just not going to come out ahead. You may win a few, but it's like deciding you're going to go one-on-one with a NBA star.
One last question before you take off. What about the extremes that we've seen over the past few decades in the conditions in financial markets? How much does that impact the psychology of investors in making them prone to making decisions that are bad for themselves?
So, yeah, volatility brings up emotions. Mm-hmm. So, and emotions get people in trouble in both directions. So we found in the late 90s, 98, 99, there was, the dot-com stocks were going through the roof. People who had never traded speculatively started to do so. I had a friend who's a retired school teacher in Canada that sold all of her Canadian mutual funds to buy US high-tech stocks, and she did it right before the crash. So good markets can get you in trouble, and then the other sort gets you in trouble, that a lot of people panicked during the financial crisis and sold all of their equities and their mutual funds and went to cash, and when the market recovered, they missed out on the recovery. In general, investors are better off taking a buy and hold approach, not trying to outsmart the market, but just, to
ride it out.
Ride it out. Don't come putting everything in when the market goes well. Don't panic when it does badly. Just take a long ride.
You just heard from Terrance Odean. He's a professor of finance at Haas School of Business at the University of California in Berkeley. I'm Ron DeLegge with ETF Guide. Thanks for watching Marketplace Minute.